This video looks at how we can use monetary policy to smooth out the business cycle. Monetary policy can be used instead of fiscal policy or alongside it. So monetary policy is done by the Bank of Canada, which is Canada's central bank. So we talked about the Bank of Canada as part of Canada's banking system in the last tutorial. And we said that although the Bank of Canada is responsible for issuing currency, the private banks actually play a much larger role in creating the money supply. But the Bank of Canada can intervene to influence that money creation process by manipulating interest rates, and this is called monetary policy. So the stated goal of monetary policy in Canada is to keep the inflation rate low and stable. So the bank currently targets a goal of 2% inflation, and it will intervene if inflation gets much above or below that target. This also has the effect of keeping aggregate demand stable, because if you remember from our discussion of the business cycle, the inflation rate tends to go up when the economy is booming and down when the economy is contracting. So if the inflation rate is low, that's a signal that the economy is struggling. And as a result, the bank will intervene to stimulate the economy, which will bring both inflation rates and aggregate demand back up. So we'll talk about how that happens in a minute. The other two functions of the Bank of Canada are to oversee the overall financial or banking system in Canada, make sure it's functioning well, and it also acts as the banker to the private banks. And it also acts as the banker for the Government of Canada. So that includes managing government bonds and finances, which also plays a role in monetary policy. So here's our full Keynesian model again. And remember that for fiscal policy, the government intervenes in this cycle through taxes and government spending. For monetary policy, the Bank of Canada intervenes by indirectly affecting levels of savings and intended investment. And it does this by influencing interest rates. So if the Bank of Canada wants to stimulate the economy, it will lower interest rates. That tends to make it less attractive to save money because you don't earn as much interest on the money that you have in the bank, so you're more likely to spend that money rather than saving it. That reduces the leakage from the cycle and increases consumption. The other, and usually more important effect of lower interest rates is to stimulate intended investment. So firms that want to invest tend to finance their investments by borrowing. So you want to expand your factory, so you go to the bank and try to get a loan. The lower the interest rate, the cheaper that loan will be because you have to pay less interest when you pay your loan back. So lower interest rates tend to mean higher intended investment, which means higher aggregate demand. And if the bank wants to instead slow down the economy, it'll do the opposite. So it will raise interest rates that will tend to increase savings, decrease consumption, and decrease intended investment. So the next question is how the bank is able to influence interest rates. So most interest rates in Canada are actually set independently by the private banks. If you want a loan from RBC, for example, it's RBC that decides how much interest you have to pay on that loan. But the private banks' interest rates are influenced by a rate called the overnight rate. So the overnight rate is the interest rate in the overnight market. The overnight market is the market where private banks borrow from each other to maintain their desired reserves. So if you remember, reserves are the money that banks keep on hand so that when customers go to withdraw their money, the bank actually has some money to give them. So each bank decides how much money it wants to keep on hand, but if it has a lot of withdrawals one day, its reserves might be smaller than it would like to have. So the bank's response to that is to borrow money from another bank to get its reserves back up. And these loans are on a very short-term basis. Typically they're just overnight, which is why it's called the overnight market. So the amount of interest that a bank has to pay on its loan from another bank is determined by the supply and demand of overnight funds. So here's a diagram of the overnight funds market. The supply curve is the amount of money that banks that have excess reserves are willing to loan to another bank. So the higher the rate of interest that they get on those loans, the more they're willing to loan. The demand curve is the amount that banks with too few reserves want to borrow from other banks. The equilibrium overnight rate is the rate that makes the quantity supplied and the quantity demanded equal. So the overnight rate affects the interest rate that banks charge on loans to their individual customers, because the higher the overnight rate, the more it costs a bank to borrow from another bank if it ends up running short of funds. So the higher the overnight rate, the more banks will want to keep on hand and the less willing they will be to loan that money out to customers. So the less willing the bank is to lend, the higher the interest rate it's going to charge to its customers. It's less willing to lend, so it charges a higher interest rate, which tends to discourage customers from wanting to borrow. So the Bank of Canada can influence the interest rates that banks charge to their customers by influencing the overnight rate. And the main way that the Bank of Canada actually does this is just by announcing a target for the overnight rate. So the Bank of Canada does that 8 times a year, and they either say that they want to keep the current overnight rate or that they want to target either a lower or a higher rate. When they do that, they also promise to lend commercial banks as much money as they want at an interest rate 0.25% above the overnight rate, and that rate is called the bank rate. The bank also promises to pay commercial banks interest on deposits that they have at the Bank of Canada at a rate 0.25% below the overnight rate. So that's called the deposit rate. So suppose that the Bank of Canada announces that it wants to lower the overnight rate from 6% to 5%. So that means that it will now make loans to commercial banks at a rate of 5.25%, the bank rate. And before that, it was charging 6.25%. So that means that demand for overnight funds tends to fall because banks can now borrow from the Bank of Canada for cheaper than they could before. The bank also promises to pay banks 4.75% on their deposits at the bank, and previously it was paying 5.75%. So that tends to increase the supply of overnight funds because banks would now rather lend to other banks instead of keeping their money at the Bank of Canada. So the overnight rate ends up right around 5%, which is exactly where the bank wants it. As a result of the overnight rate falling, banks are now more willing to make loans to their customers because it's cheaper for them to get overnight funds if they need them. That means they will charge lower interest rates to their customers. That makes businesses more willing to take out loans. That tends to increase intended investment, and that increases aggregate demand. Banks also pay less interest on deposits that their customers make, so checkings and savings deposits, and that makes people less willing to save, more likely to consume. Aggregate demand goes up as well as a result. So what I've just described is conventional monetary policy. So this is what banks typically do. Recently, some central banks have started using what's called unconventional monetary policy on top of their regular monetary policy. And they do this when their country is in what's called a liquidity trap. So a liquidity trap is when conventional monetary policy is no longer effective. So that can either happen because the central bank has already lowered the overnight rate as far as it can go, or because private banks have simply stopped responding to decreases in the overnight rate. So the central bank lowers the overnight rate and private banks don't lower their interest rates in response. So central banks have 3 options if they're in a liquidity trap. One is to actually make the deposit rate negative. So they make the overnight rate 0 or actually even negative, and then the deposit rate is negative, which means that instead of the central bank paying private banks money on their deposits, the private banks actually have to pay to keep their money at the central bank. So in theory, this should make them want to loan the money to their customers instead and should make them want to lower interest rates. So Japan and Sweden have both used negative interest rates. The Bank of Canada has not so far, but has also said that it won't rule it out as a possibility. A second option is to use quantitative easing. So here's our overnight market again. Quantitative easing means that the Bank of Canada, or whatever central bank it is, directly increases the supply of overnight funds by buying assets, usually bonds, that the private banks hold. So those banks now have less assets and more money. And the bank uses brand new money that it just creates in order to buy these bonds. So it just says, hey, I have some money, I'm going to use it to buy these bonds. That means that the banks now have excess money, so the supply of overnight funds increases and the overnight rate falls, which should make them, again, lower their private interest rates. So essentially what the central bank is doing is pumping billions of dollars in new money into the banking system. And the USA and Europe have both been using quantitative easing over the last few years. And then a third option for unconventional monetary policy is for the bank literally to print new currency and inject it into the economy, usually by giving it to the government to spend. So this is actually something that lots of governments have done in the past. Typically they don't do it intentionally as part of monetary policy, but it does tend to have that effect.